let's look at how to make option trades. Note we're using interactive brokers here. However, the concepts that we're going to talk about can be applied to trading in any account, right? We're really just looking at, what are the considerations to take into account when trading options. And the interface, different accounts have different interfaces, but the underlying concepts are the same. So first, one thing, in talking about the interface in interactive brokers, we can trade options in two different ways. One, we can use this option trader, which I have open here. And what I would do is I'm going to take a look at Signa Options. So we can trade, with this interface. This gives us some more information, and a lot of brokerage accounts will give you, this information that you're seeing here. So I might as well run through it really quickly. So what we're seeing here, I guess, looking here, we have in options there's two different kind of volatilities: historical volatility and implied volatility. If you haven't talked about option pricing yet, just know that we can observe the price and back out what the market thinks the volatility is. That's the implied volatility. Historical is just backward looking. You mostly care about the implied volatility, right? But they'll give you like a lot of accounts will give you like historical versus implied volatility and so forth. Just know implied volatility is forward looking, historical is backward. We're going to do some simple option trades, so none of that matters to us. Another thing that really doesn't matter to us is we're given delta, gamma, theta, vega, theta. This is used for understanding the options behavior and putting together more complex trading strategies. Delta is just the amount by which the sensitivity of the option price to changes in the underlying stock price. Gamma is the rate of change in the delta. Vega is the sensitivity of the option price to changes in volatility, and theta is sensitivity of the option price to changes in time. So again, today in what we're doing here, we just want to make simple option trades. None of this will matter. What will matter more is volume. This is how many contracts have traded. Remember, a contract is for 100 shares. And open interest, right? So this is going to be meaningful to us today. What this means is how many contracts are in existence. So the idea is, remember, when you trade a derivative, we use the word trade loosely here. If I go and buy an option contract, I'm actually creating an option contract. This is different than trading a stock. If I go in and let's say I buy Signa stock, right, ticker CI here, I'm not creating a share of stock. A share of stock exists and I'm buying it from someone else. This is not the same in when we talk about derivatives like options. When you buy an option contract, what you're doing is you're creating a contract and you're entering into the side that gives me, in this case, options, the right to buy at the underlying stock at a set price, right? So a contract comes into existence. Similarly, if I don't have any position and I sell, I write an option again. When somebody's on the other side buying that option, that brings an option. Creates an option. It brings an option into existence that didn't exist before, right? So this is how many options are in existence. At each, I should kind of mention, when you look at options, this is going to be call options, this is put options. These are the strike price. So let's just take the 290 strike price call options expiring on October 13th, 2023. So 290 strike price calls. There are 65 in existence, 65 contracts. Now, let's say I bought one of these, right? So I buy one of these, somebody sells, so open interest goes up by 1. Then, a couple days later, I turn around and I have a position in this and I sell it, which means I get rid of that contract. So the open interest would go down by 1. Right, so this is the number of contracts that are in existence. Good. Yeah, so I often trade on, actually when I'm usually using this account, I might do, you can also bring up options here, right? And you get kind of the same view, but it's somewhat abridged. A couple other, so I'll look at both of these. I think going forward I might just look at this because there's less information. We don't need a lot of information. So again, these are Signa options. Actually, this is for expiration 11 days, 39 days, 102 days. Let me just look at the 11 days. What I've done is I've brought in all strike prices, right? So one consideration to make when you're trading options is if I was trading Signa stock, right? Let me bring up Signa stock here. So let me just CI. Now, actually, it's not too big of a bid-ask spread. So, meaning it's 29 cents, but it's on the stock is priced at 290. So when I'm trading this stock, I don't really have to worry about market or limit order. I don't really have to worry about the bid-ask spread. Let's just calculate the percent bid-ask spread, right? So just so we can see it. So what we're looking at is put numlock on 290 let's just say 3 divided by 290, right? So we have a 0.1% bid-ask spread when looking at Signa. Now, if we bring up Signa's options, now remember, bid-ask spread is transaction costs. Well, the bid-ask spread can be, quite sizable. So here, this is an at-the-money option. So what we're looking at is Signa's 290, and the strike price here is 290, right? So this is our at-the-monies. You can think of, 290 would be at the money. So 530 times, so what we have, ask of 5.7, bid of 5.3. So taking a look at this, 5.3 minus 1. So now we have, did I do that right? 7% bid-ask spread, right? So that's, that's orders of magnitude, larger, right? 70 times larger, 75 times larger. So bid-ask spreads are much larger. So in other words, if I'm going to go in here and trade an option, right, I'm much more likely to use limit orders to try to narrow that bid-ask spread. Now, I purposefully looked at the money options, right, because these are generally have tighter bid-ask spreads. I can go down to here, and it looks like this one's the most heavily traded today. It's somewhat out of the money. This is a call option, so this is out of the money. Still a fairly large bid-ask spread, but let's go a little bit further out of money. Now you see, well, there's just no bid, right? So here we have no bid and an ask of 25 cents. So you really don't want to put market orders in here, right? So if I put a market sell order for this option in here, right? Someone might pick it up at like, I might sell it for a half a cent or something like that. So the idea here is you want to when you're trading options, particularly, well, I didn't say always. When you're trading options, pay a lot of attention to the bid-ask spread because it can be sizable. Right, let's just see when I go out here. What do we have? 0.45 bid-ask spread 0.3, 0.45, which is just, like I say, this is a massive bid-ask spread. So be very careful, pay a lot of attention, and then to the size of the bid-ask spread, and then use generally limit orders as opposed to trading a stock. Okay, so there's some basic considerations. There's a trading assignment. So with this, the first trading assignment here just goes in and says, okay, well, buy a call, buy a put, sell a call, sell a put. So how do we sell, buy, and sell options, right? So let's just I'm going to take an actual, what do we want to buy a put option on Tesla, sell a call. Let me start off by saying sell a call option. All right, and then what do we want to do this on Snapchat? Okay, and I'm just going to trade at this interface. So Snapchat is ticker SNAP, and I've already forgotten what I want to do. Sell a call option. So if I sell a call option, and what I say here is choose choose the most heavily traded strike price, right? So that's trying to get you to kind of take a look at how trading is distributed among the different strike prices. I was actually going to do this over here, so let me, because I brought in a lot more strike prices. And I think I say there, choose your maturity. So we'll just take the 11 days to maturity. Snapchat, yeah. So, and if we want to buying and sell, once we've chosen the option, so let's what's the most heavily traded call? So it's pretty much an at the money. Called the price is 865, so the strike price is 9, and I think we wanted to sell this. So all we have to do is, once we've chosen this option, is sell. I mean, maybe just take a step back here. It is neat to see. So this option has 1,170 contracts traded. You go 2 strike prices away here at 8, and there's only 33, right? So you can see just the distribution of the trading among the strike prices is, it tends to concentrate on any given day. Note that there's a lot of open interest out here. So this might have been kind of the at the money option some previous days, but you can see that this one right here has the most. So maybe this was at the money and then Snapchat fell. But you can see the distribution of the trading among the options is not like a normal distribution, right? It's really concentrated in one point. All right, so once we know that this is the option we want to trade, it's easy. If we want to sell it, right? So I think that put that option up here. Sorry, this enter. So that put that option here, right? And we want to sell this thing, so we can go in and say sell, right? Sell one. So all I did here was click the bid. Right, sell this option, day limit. Now, one thing, note the bid-ask spread is actually fairly narrow here. So, I looking at it, right, and there's a lot of options for trade at the bid. I could probably change this to a market and not worry about hitting 16, and go ahead and transmit. Yeah, well, we do have, I think the market data we have here is delayed, and normally, I wouldn't trade anything with delayed market orders. However, for the trading assignment, we can go ahead and override and transmit, and I've sold one call option. So, once you have an option up, right, it's easy to buy or sell. So by doing that, I've written the option, right? In other words, actually buying and selling an option is just a bid-ask spread, just like a stock, right? So, now if it was a put option, right? If I wanted to sell a put option, and I'll do it on the same stock here. No, I have to bring up. This is a call option with a strike price of 9 with this. So expiration date. If I were to want to trade a put option, right, I would have to bring up an entirely different option, right? So let's see, this is the most heavily traded, so I can go ahead and click this put option. Again, puts up here, and then close this. I have to kind of switch between tabs because of my window manager. And then, if I wanted to buy this, I would, click there and I would buy, right? There's my buy order. And then if I wanted to sell this, I would sell that there, right? So, make sure that you're paying attention to this is a call, this is a put, right? You have, when we're trading options, you have expiration, you have ticker, expiration, strike price, and then whether it's a call or a put. We can go in here and see exchange traded on Gemini, see some details of it. What was so we sold this thing. It was a market order, right? So that was so we sold it for 18 cents, which was nice. Commission $1.45. Good. All right. So that should get you into just simple buying and selling, right? So now, you can buy call options, buy a put option, and if it's easier, you can always work in something here like the trader workstation. You can go in here. So if I want to trade Tesla options, right, I can bring that in. Maybe it's easier to trade in this because look, let's say, what do I want to do here? I want to buy a put option on Tesla, right? So I buy, I'm going to bring 11 days out. Here's my put options. I want to buy one. There's a lot of trading out here. So I'll buy the 255, right? So I just go ahead and click the ask, and then it'll put, so here I can have multiple orders, right? So I can go ahead and, and then it's just, it has my buy order in here, and I can go in and change this to, well, keep it as a limit and go ahead and execute the order right from here. Okay. Last thing to say is in the trading assignment 5, you have to trade spreads, right? This isn't difficult, so I think what do I say here? I guess I don't tell you what stock to trade. So if I want to trade a covered call, right? I want to create a new spreads. So, if I want to do a covered call, what stock do we want to do a covered call on? NVIDIA. Right, so I can bring in NVIDIA stock, and then what's NVIDIA trading at? 454. So if I were to, so a covered call is I buy the stock and I sell a call option. So if I want to sell a call option, I might sell the 470s maybe. So options. So I'm going to sell a call option on this. Hey, I want to go at least 11 days out. I want to go 39 days out, more reasonable. And I'd probably want like the 470s. I should be able to click multiple ones, 470, 480, 490. All right. So, now to execute this covered call, right, I just do 2 separate trades, right? So I'll go ahead and do this. I'll buy. Now, one thing to keep in mind is I do so if I'm going to sell, each option contract is 100 shares. So if I'm going to sell one option contract, I need to buy 100 shares of Lockheed Martin. So, okay. So let me say 200 shares here, and then I'm going to go ahead and sell 2 contracts. Which one should we do? I mean, what I could do is kind of look at, I don't have any of the data on here looking at the implied volatilities or so forth, so I don't know. Let's just choose. I started with the 470s, so let's just choose the 470s. So I'll go ahead and click the bid, sell 2, day limit, right? And 1805, let's what are limit prices? Let's just say we want to get it done. So I'm going to put a limit at the bid, so it should go through it immediately. So, and then I'm not too worried about this, so I'm just going to say market, transmit, all right, transmit, all right. So let's see here. This actually hasn't been executed yet, 1805. Normally this should have. All right, let's just assume that the price is going to stay. There we go. And now I can look at my trade log and see, okay, well here are my prices, right? So I bought the stock at 453.60. Ooh, I sold the option at 1755. So keep in mind, this is 100. This is per option. This price is per option, right? And then for the entire contract, so I would have received $1,755. And then what you can do is, given these 2 prices, this is the price at which you bought the stock, this is the price at which you wrote the option, you can go ahead and calculate max gain, max loss, break even for the covered call. And I have other videos on how to do that. So you do that for each. But the idea is a protective put. Just go in there, buy the stock, sell a put. Caller, you're going to buy the stock, sell a call with a higher strike price, buy a put with a lower strike price. So you can put these together, just trading each individual a transaction separately. Anything else I want to say before we're done here? One thing I mentioned here is I'm actually asking long or short on this. Like if you buy a call call option, are you long or short? Long or short are just ways of saying if you're long, you make money if the asset goes up. If you're short, you make money if the asset goes down. So the idea here is with a call option, you're long the underlying, you're long Apple. If you buy a put, you're short. If you sell a call option, you're happy if the stock Snapchat doesn't do anything, because then you earn time value, that you earn the theta, or if it goes down, so you'd say short, long. I mentioned that long and short aren't really important in for trading an individual option, but once we start putting more complex trades together, like if we did a bull call spread, right? So we're buying a call with a lower strike and selling a call with a higher strike. You might say, well, am I long or short the underlying? Just to get an idea of what what this multiple option spread does, right? So you can get used to those terms, long and short. All right, I think that should be enough information to do these two trading assignments. Have a great day.